Hi, welcome to the unit Introduction to the Accounting Principles. My name is Reena, and we are going to understand the basics of accounting principles. Previously, we have discussed LO1 relating to understanding what is accounting equation and how you can use the accounting equation to calculate assets, liabilities, or capital. And we have also seen LO2 that was relating to enhancing our understanding of the accounting policies, principles, and concepts. Before we go ahead with LO3, let us take a moment and recap what we have learned in LO1 and LO2 so far. Let me just make it a little bigger for everybody's purposes. So we learned that the accounting equation is asset is equals to liabilities plus capital. And we also saw how to use the accounting equation to calculate assets, liabilities, or capital by rearranging these elements, as there is interdependency amongst these three elements. Let's quickly recap also what we have discussed in LO2. We started with understanding the difference between accounting policies, principles, and concepts. We learned that accounting policies are specific to each organization, whereas accounting principles are broader rules that ensure that the financial statements are prepared consistently and in accordance with generally accepted accounting principles. Accounting concepts are kind of an umbrella framework that guide the creation of accounting standards and principles. We also walk through the key accounting policies like methods of depreciation, inventory valuation, some of the key accounting principles like principle of prudence, principle of consistency, and we also saw key accounting concepts like going concern concept, economic entity concept. We also analyzed the need for the organizations to use consistent accounting policies, principles, and concepts so that there is comparability, reliability, transparency, overall increase in operational efficiency. And lastly, we evaluated the benefits for an organization when it follows an internationally set accounting policies, principles, and concepts. We have seen the benefits were ranging from global recognition to improved access to capital and to streamline financial reporting and investor confidence. Now let's take a look at the unit specification sheet for LO3. Now, LO3 has three past tasks, that is 3.1, 3.2, and 3.3, one merit task, and one distinction task. The focal point of LO3 is to develop your ability to prepare ledger accounts using the double entry accounting principle. And this step is essential for you to understand, or it's basically essential for anyone who's starting in the field of accounting. We are going to see some of the key topics or the questions that we are going to try to find an answer to. Like, what are the principles of double entry in ledger? Why do you make double entry ledger? What are the golden rules of accounting? What is the need of double entry bookkeeping system? What are the benefits and drawbacks of using double entry bookkeeping system? You can use the web link to see a short video on double entry bookkeeping system that is given for your easy access. So now double entry bookkeeping system is basically a system where every financial transaction that is getting recorded, it is affecting at least two accounts in opposite ways. So the idea behind these two accounts being impacted in opposite ways is to make sure that the accounting equation always remains balanced. If I have to say it simply, I can say simply that each transaction, for every transaction, there will be two entries, a debit entry and a credit entry. Now let's see the golden rules of accounting. There are three golden rules of accounting. Number one, debit all expenses and losses and credit all incomes and gains. Number two, debit the receiver, credit the giver. And number three, debit what comes in and credit what goes out. During the course of this discussion, you will understand why exactly these rules and how to apply these rules. The basic concept is that every transaction is recorded using at least two accounts. One account is debited and the other account is credited. So the debits and credits must balance. It means that the total debits must equal to the total credits for each transaction. The importance of this system is to make sure that the accounting equation that we have studied in LO1, that is assets is equals to liabilities plus equity, this remains in balance after each transaction. We have 5 different types of accounts. That is asset account, liability account, equity account, income accounts, and expenses accounts. Assets, liabilities, and equity accounts we have covered in depth in LO1. Now let's see what are income and expense accounts. Income accounts are basically those accounts that represent the revenues that is generated from the primary business activities. Whereas expense accounts are the accounts representing costs incurred in generating revenue. Any kind of expenses that you are doing to generate any kind of revenue will go under an expense account. Now, the debits and credit affect different types of accounts in opposite ways. Now, we will shift our focus to understand what goes to which account in debit and credit universe. So what we are going to do is that we are going to see how to apply the 3 golden rules of accounting. First is debit all expenses and losses, credit all incomes and gains. So any expense accounts are to be debited to record any increase, and any revenue account, they are credited to record the increase. Second is debit the receiver, credit the giver. So any decrease in liability and equity account are to be recorded as debits, and any increase in liability and equity accounts are to be recorded as credits. And the third rule is debit what comes in and credit what goes out. So if there's any increase in any asset account, that has to be recorded as a debit. And if there's any decrease in asset account, it is recorded as a credit. Thereby, the 3 golden rules: debit all expenses and losses, credit all incomes and gains, debit the receiver and credit the giver, and debit what comes in, credit what goes out. Now, let us see an example of how to set up a simple ledger as a process of recording transactions. Now, if you see, whenever any transaction occurs, the first step is to analyze to determine which accounts are affected and how they are impacted. Entries are then made in the general ledger, recording the transaction date, the accounts that are debited and credited, and the amounts that are involved through applying the double entry rule. The double entry system ensures that the accounting equation remains balanced after each transaction. Let's take a look at a practical example of preparing a simple ledger. The scenario given here is a company that is purchasing £500 worth of office supplies with cash. The golden accounting rule of debit says what comes in and credit what goes out. That is going to apply here. What is coming in is office supplies. So we are going to record office supplies on the credit side. And what is going out is cash. So we are going to record cash on the debit side. This is an explanation that you can see of the ledger entries, and this is a ledger table example. The double entry bookkeeping system provides a systematic and accurate way to record financial transactions and maintain accounting records. This basic understanding will help in future when you are doing more complex accounting tasks and in an overall financial management. So let's start with AC 3.1, outline the double entry bookkeeping system. Now, AC 3.1 requires you to outline the double entry bookkeeping system. The discussion that we have done so far is in parts dealing with the AC 3.1. I will slowly walk through the entire discussion for the sake of clarity. Let's start with understanding what is double entry bookkeeping system. As we discussed, double entry bookkeeping is a system wherein every financial transaction is going to affect 2 accounts in opposite ways. The idea behind is to make sure that the accounting equation remains balanced at all time. And this system is based on the concept that every transaction has a dual effect and is crucial for maintaining the balance of the accounting equation. Now let's take a look at the core principles of double entry bookkeeping system. Firstly, there is dual effect. As we discussed that one account will be debited automatically the other account is to be credited by an equal amount. Then only the accounting equation will remain balanced. So the debits and the credits must balance, meaning thereby that the total debits must equal the total credits for each transaction. And importance of the system is to make sure that the accounting equation remains balanced after each transaction. Secondly, debits and credits. Now, debits, the entries on the left side of the account are called debit side, and the entries on the right side of the account is called the credit side. When we are trying to understand what is debit, what is credit, it is important to keep in mind the three golden rules of accounting that we have discussed. That is, debit all expenses and losses, credit all incomes and gains, debit the receiver, credit the giver, and thirdly, debit what comes in and credit what goes out. Now let's see the steps in operation of double entry bookkeeping. The first step when you are operating or when you are starting to make a double entry bookkeeping system is identification of transaction. When any transaction occurs, we have to understand the nature of the transaction and its impact on the business's financial position. The second step is seeing which are the affected accounts. We have to identify which accounts are getting affected in this transaction. And this basically involves deciding whether the accounts involved are asset account, liability account, equity account, revenue account, or expense account. And then in the third step, we have to apply the dual entry concept. That means for every transaction, we have to make one debit entry and one credit entry to make sure that the total debits equal the total credits. Let's take an example of a double entry bookkeeping. The scenario is of a business that buys office furniture for £1,000 in cash. So the first thing is, let's see which two accounts are affected. That is the furniture, the office furniture account, and the cash account. Now the golden rule of debit what comes in and credit what goes out applies here. What is coming in is furniture. So we are going to record furniture on the credit side. And cash is going out. So we are going to record the cash on the debit side. Double entry bookkeeping. Let's take a look at the benefits of double entry bookkeeping. Now, double entry bookkeeping has several benefits that has contributed to its widespread adoption around the world. The first step is accuracy. Double entry bookkeeping provides a systematic and reliable method for recording the financial transactions. By requiring every transaction to be recorded in at least two accounts with corresponding debit and credit, it reduces the risk of errors and it ensures the accuracy of financial records. Second benefit is error detection. Now, double entry bookkeeping maintains the fundamental accounting equation, that is assets is equals to liabilities plus equity. And in this process, it ensures that total debits are always equal to total credit. This balance serves as a built-in error detection mechanism, allowing for any discrepancy to be quickly identified and corrected. The third benefit is clarity in financial analysis. Double entry bookkeeping produces detailed and structured financial record. The most important, the key word here is structured financial records, because then what happens is that it facilitates financial analysis and decision making. When you're organizing the transactions into specific accounts, it allows the managers and the stakeholders to assess the financial health, performance, and ongoing trends of an organization seamlessly. Fourthly, comprehensive records. Because every transaction is affecting at least two accounts, double entry bookkeeping makes sure that all financial transactions are properly recorded and accounted for. This reduces the overall likelihood of omitting any important transaction, which leads to more complete and comprehensive financial statements. Of course, there are other benefits also like financial control, because the nature of a dual entry bookkeeping system provides a clear audit trail for all transactions. It makes it easier to track the flow of funds and monitor financial activity. Overall, it enhances the internal control and oversight, reducing the risk of fraud, mismanagement, or any kind of unauthorized transactions. Then there is an element of legal compliance to it, as many regulatory bodies and accounting standards, they actually require the organizations to maintain accurate and reliable financial records. Double entry bookkeeping helps the organizations comply with these financial, legal and regulatory requirements by providing a standardized and transparent method for recording financial transactions. So just to summarize, we can say that the structured format of double entry bookkeeping simplifies the preparation of financial statements, such as balance sheet, income statement, cash flow statement. These statements, the main idea behind these statements is to provide valuable information to the investors, the creditors, other stakeholders, and overall supporting transparency and accountability. So this all put together facilitates financial reporting. This system is integral to modern business accounting practices, and it is adopted universally across different industries and different business sizes. Let's take a look at the AC 3.2, that is process accounting data using the double entry bookkeeping system. Now, processing accounting data using the double entry bookkeeping system involves recording every financial transaction in at least two accounts in opposite ways to make sure that the accounting equation remains balanced. This system is based on the concept that every transaction has a dual effect, as you have seen in the earlier discussion, and this is crucial for maintaining the balance of the accounting equation. Let's see the steps in processing accounting data. It starts with identification of the transaction, followed by classification of the accounts affected, that is assets, liabilities, expenses, revenues, equity, etc. And then determining the debits and credits using the golden rules of accounting. Now, further into the steps, you have to make an actual entry in the accounting journal, specifying the date, accounts involved, and the amounts for debit and credit. Once you have recorded the journal entry, you have to post it into the separate ledger account. So there will be, for every transaction, there will be posting into two separate ledger account, because there will be two accounts that are getting affected. This step updates each account's balance accordingly. And lastly, review the ledger account for accuracy and make adjustments as necessary. Mostly the adjusting entries are done at the end of the accounting period. Now let's reinforce this concept with a practical example. Let's consider a business transaction where a company is selling product worth £2,000 on credit. So first step is identifying the transaction. The transaction is we are selling a product worth £2,000 on credit. Second step is classifying the accounts involved. Here, the accounts receivable, because we are selling on credit, that's the first account. And second account is the sales account or the sales revenue account. Third step is determining the debits and credit. Debit the accounts receivable to increase the assets, and credit the sales revenue account to increase the revenue. Next step is recording the journal entry. So if you can see, there's an example of a journal entry for transaction on the date of sale. There's an account receivable. In the debit section, we'll put £2,000. And for the sales revenue, a corresponding entry for £2,000 will be done in the credit section. And then you have to post this to the ledger account of accounts receivable ledger and sales revenue ledger. And lastly, review and adjust. Any discrepancies that are found later, maybe there was sales return or there was any discount, that will be adjusted with new journal entries. And there is another example wherein we are purchasing a £500 worth of inventory. The things are same. You have to identify the account and then debit what comes in, credit what goes out. And we are doing that and seeing the inventory account is being debited by 500 and accounts payable account is being credited by 500. We have to increase the liability account because this is the amount that is owed to the suppliers. To conclude, we can say that the double entry bookkeeping system is a systematic approach to maintaining financial records, and it is important to ensure the accuracy and accountability. It provides critical financial information for decision making. Now we have reached to AC 3.3, that is prepare ledger accounts for a specific organization. Here we have used an example of UK Versity. You can use any organization of your choice as far as you are capturing all financial activities related to revenues, expenses, assets, liabilities, and equity. Let's see the common accounts here. Here we have tuition fees, government grants, donations received, buildings, salaries and wages, etc. Now we will see example of preparing specific ledger accounts. So here we have tuition fees billed for £2 million, billed for the semester. Government grant received is £500,000 received for research funding. Salaries paid is £1.2 million paid to staff. Equipment purchased £100,000 for new laboratory equipment, and donations received is £150,000 received from alumni for development funds. These are the ledger entries. For each account, we have to create a separate ledger account. So for example, the tuition fees receivable, here you have billed the tuition fee, so that's a debit. And once you receive the tuition received amount, once it is received, then we will credit that amount. Similarly, there's a ledger entry for government grants, salaries and wages, and equipment. This is the explanation of these journal entries. Let's take a look at the 3M1, that is, analyze the usefulness of the double entry bookkeeping system. The double entry bookkeeping system is highly useful for organization because it ensures the accuracy, completeness, and reliability in the financial records. It also provides financial control and support the financial decision making. It facilitates in compliance and creates a historical record for learning and further planning purposes. And because it's a structured way of recording transaction, it enhances overall transparency, accountability, and efficiency in financial management. Let's take a look at these benefits one by one. We will start with accuracy and error detection. One of the primary benefits of double entry bookkeeping is its ability to ensure accuracy and reliability in financial records. By recording every transaction in at least 2 accounts with corresponding debit and credit, the system helps minimize the errors and discrepancies. This dual recording makes it easier to detect errors when the books do not balance, as the sum of debits should always be equal to the sum of credits. Secondly, comprehensive financial overview. Now, because every transaction is supposed to affect at least 2 accounts, double entry bookkeeping ensures that all financial transactions are properly recorded and accounted for. Unlike single entry bookkeeping, which only records one side of the transaction, double entry bookkeeping reflects how each transaction impacts different aspects of the business. This reduces the risk of omitting important transactions, which ultimately leads to more complete and comprehensive financial statements. And then you have the benefit of enhanced financial management. The dual entry nature of the system provides a clear audit trail of all transactions, making it easier to track the flow of funds and monitor financial activity. Ultimately, this enhances internal control, reducing the risk of any kind of fraud, mismanagement, or any unauthorized transactions. The financial records produced are detailed and structured, and they facilitate analysis and decision-making. It allows the stakeholders to assess the financial health, performance, and trends of an organization effectively. For example, if you take a closer look at the accounts receivable and accounts payable ledgers, we can easily manage the cash flows effectively. So to ensure that the business remains solvent. Next benefit is accountability and transparency. Double entry bookkeeping enhances accountability and transparency because each financial transaction is recorded to reflect both the source and the use of funds. This transparency is essential for internal audit and for any kind of regulatory compliance, and even during the scrutiny of the financial statements by external stakeholders such as investors, creditors, or the tax authorities. It also facilitates growth and complexity. For large corporations with diverse operations, double entry bookkeeping ensures that all financial data is organized and accessible, supporting strategic planning and operational efficiency. And then there is historical and comparative analysis. Now, the double entry bookkeeping, it creates a historical record of financial transactions over a period of time, providing valuable insights into past performance and trends. This historical perspective facilitates historical financial data analysis and comparisons over a period of time. This is particularly important in case of strategic planning and for securing investment, as it provides a reliable financial track record to take a look at. So essentially, we can say that the usefulness of the system is evident in its universal adoption by the businesses around the world. This underscores its essential role in effective financial management and accountability. We are down to the distinction task, that is 3D1, wherein it says, evaluate the benefits and drawbacks of using the double entry bookkeeping system. We have just covered the benefits of using double entry bookkeeping system, such as accuracy and error reduction, comprehensive tracking and financial control, regulatory compliance and decision support, etc. There's no point of repeating it here again. Let's focus our energies on evaluating the drawbacks of using double entry bookkeeping. Now, the first and foremost is complexity. The double entry bookkeeping can be complex, especially for individuals or small businesses who don't have a background in accounting. Understanding the principles, rules, and procedures of double entry bookkeeping, it requires time and effort. And then mistakes can occur if users are not adequately trained or experienced. Secondly, learning and mastering double entry bookkeeping can be time consuming. This may be a barrier for individuals or organizations with limited accounting knowledge or resources, and they may be requiring additional training or professional assistance. Also, double entry bookkeeping requires careful recording and reconciliation of transactions, which can be time consuming, especially in case of those organizations who have high transaction volumes or complex financial structures. Thirdly, implementing and maintaining double entry bookkeeping system can be costly, especially for small businesses with limited financial resources. Setting up and maintaining a double entry bookkeeping system requires significant investment in both software and skilled personnel. Dependency on software may lead to technical issues disrupting financial operations. Costs may include software, training, professional services, and ongoing support, which may act as a financial burden for some users. Fourthly, while the entire base of double entry bookkeeping is to minimize errors and discrepancies, it is not completely immune to mistakes. Sometimes inaccurate data entry or misclassification of transactions or any kind of a human error can lead to inaccuracies in financial records that can go unnoticed without proper oversight or reconciliation. Also, implementation and maintenance of double entry bookkeeping system require skilled personnel with expertise in accounting principles and practices. This may pose challenges in recruiting and retaining qualified accounting professionals. So these are some of the drawbacks of double entry bookkeeping system. Here, there is a table for your quick, easy reference, wherein the advantages and disadvantages have been prepared. Let's quickly recap what all we have discussed in this LO. We learned that double entry bookkeeping is a system where every financial transaction affects at least two accounts in opposite ways to make sure that the accounting equation remains balanced. We captured the three golden rules of accounting, that is, debit all expenses and losses, credit all incomes and gains, debit the receiver, credit the giver, and thirdly, debit what comes in, credit what goes out. We looked at practical example of preparing a simple ledger. We also saw the steps in operation of double entry bookkeeping, such as identification of transaction, determining affected accounts, and application of dual entry. That means for every transaction, we have to make one debit entry and one credit entry to make sure that the total debits equal total credit. We went through the benefits of double entry bookkeeping that contributed to its widespread adoption around the world, such as accuracy, error detection, clarity in financial analysis, legal compliance, etc. We evaluated the drawbacks of using double entry bookkeeping, such as complexity. It can be time consuming, it can be costly, especially for small businesses or individuals with limited financial resources. So this was all about the double entry bookkeeping system. I hope you have been able to follow through this discussion. If you have any query regarding this LO, you can reach out to us at learnerwork@ukversity.co.uk. Thank you for your time.